Welcome back, people. Today is one of our versus shows where we compare something with another. So on this episode of the Millennial Investor Series, we're going to be comparing an index fund versus a mutual fund. I'm going to be comparing them based on five key factors, basically. One, definitions, what exactly they are, what they do, and then in terms of management style, we would also compare in terms of diversity and also in terms of cost or fees associated with each fund. And finally, we'll talk about the objective of each fund. So my goal here is to help you make an informed decision, right? So as much as possible, I'd like to show you how the factors affect each fund and how you as an investor should be able to decide which one works for you. All right, so let's start. What exactly is an index fund? An index fund is a fund created to track and mirror key benchmark indices in the stock market, right? An index fund is something that was created to track theoretical segments of the stock market. So in Nigeria, for instance, we have the all share index. Now that index tracks how the performance of all of the stocks and ordinary shares that are listed on the stock market, right? And then we have the NSE top 30. That that index tracks and mirrors selected stocks, selected common stocks or selected companies, basically tracking their performance and how they perform and grow over a period of time. You also have industrial segments. So for instance, we have the NSE banking index, we have the NSE consumer goods index, we have the NSE insurance index, right? So all of those indexes are indexes that that are used to measure, track and mirror the performance of industrial segments or large companies or small companies or medium companies, or like the all share index that tracks all of the shares, ordinary shares listed in the stock market, right? So an index fund basically is created to kind of like track and mirror how the indexes work. So for instance, if an asset management company creates a fund that was created to all they do is invest in all of the shares that are listed in that indices, right? So if it is the all share index, that means that fund is investing in all the shares on the stock market. If it's the NSE banking index, that means that fund is investing in all the banks that are tracked in the NSE banking index. Sorry, I don't know why I keep saying index. If it is the NSE insurance index, that means that index fund, invests and tracks and mirrors all of the ordinary shares listed in the NSE insurance index. All right. So that's what an index fund is. It's created to track and mirror the performance or key benchmark for particular indices in the stock market. Now, a mutual fund, I've talked about mutual funds in some of my old episodes. A mutual fund is basically, a pool of assets that is actively, professionally managed by an asset management company, all right? So a mutual fund is usually managed by an asset management company, professionally managed by fund managers, and they invest actively in multiple diverse assets. You have multiple types of mutual funds, all right? So that's in terms of definitions. Back to the second factor, and let's talk about the second factor. The second factor is diversity. So with index funds, basically that's all the diversity you get. It depends on the diversity in the index that index fund is tracking. So if it is tracking the NSE banking index, then that's all the diversity you get, all right? If it is the all share index, that means you're getting everything that's going on in the stock market, right? But a mutual fund is usually a lot broader than that. So you can have mutual funds that are equity based, right? You can have mutual funds that invest in the money market. You can have mutual funds that do a bit of bonds, a bit of equity, so like balanced funds. You can have fixed income mutual funds as well. So mutual funds are kind of like really broad and diversified. And index funds are always focused on tracking and mirroring what is captured and measured by the particular index that it mirrors, all right? That's in terms of diversity. The third factor is fees and costs. Typically, mutual funds are a lot more expensive as to you as an investor. They charge fees within the range of 1% to 3% because, management fees for actively managing, because it's professionally managed by a fund manager. So they would charge you for that, and there will also be the expense ratio that is covered. So you will take, they will take stuff to basically cover the expenses of the fund managers. So mutual funds are usually more expensive to you as an investor. An index fund is passively managed because it's basically tracking the index, the indices that is already mirrored in the stock market. So they don't charge as high as the mutual fund. So the fourth point, in terms of management style, I think I've covered this in some of the other points or factors that I talked about. A mutual fund is actively managed by a fund manager, all right? So you have fund managers that are actively managing to ensure that they give you the best ROI for you as an investor. But an index fund is more passive. It doesn't really need a lot of active management by fund managers because, like I said, it's basically just tracking an index on the stock market, okay? They also track index in other markets. So for instance, they might track some bond performance indices or something, but I don't see that kind of index in Nigeria, but I know in other countries you might find some examples of indexes that actually cover bonds as well, all right? So management style is different. For mutual fund, it is more active, while for index fund, it is more passive, right? Then the final factor is in terms of objectives. An index fund is basically focused on benchmarking against the index that it is mirroring. So if it's an index fund that is the all-share index, the goal is always to, match the performance of the all-share index. So if the all-share index does a certain percentage today, then the index fund needs to at least match that. That is the core objective of an index fund. For a mutual fund, the fund managers are more focused on beating the performance index. So for instance, they might tell you that this year we did 24% and we beat the all-share index. The all-share index was what, 18% or 16%. I hope this doesn't sound too confusing or sound like gibberish, right? I'm really trying to make it as simple as I can. But I want you to understand some of the things that affect how you make investment decisions so that if someone comes to meet you and says, would you like to invest in an index fund? You know exactly what you want, because do you want something that is passively managed? Then we should do an index fund. Do you want something that basically tracks and mirrors a particular benchmark or theoretical segment of the stock market? Then try an index fund. Or do you want something that requires fund managers that are trained to do this and beat the benchmark index? Then go for mutual fund. But also know that with your mutual fund, you'll be paying management fees and covering the expenses of the fund managers. But with the index fund, you pay a lot less in terms of fees. All right. So that's it for this week. Index fund versus the mutual fund. All right. If you have any questions, leave them in the comment section. This is our versus week where we give you some financial education. All right. See you next week.